It was 1894. Czech Republic was still Austria and Hungary. The World War I had not started yet. A young man named Tomas Bata went to work for a shoe manufacturing company. But that didn't last long. He was kicked out. So he decided that he will start something of his own. He, his brother, and his sister borrowed 800 florins from their mother, rented a room, bought a few sewing machines, and started making shoes. Yes, they were cobbler by profession for many generations. Very soon, though, his brother joined the army, and his sister got married. So he had to take full control of the company at the young age of 19 years. But he did not become a great success overnight. Within the next 10 years, he had the capacity to manufacture 2,200 shoes. He could hire a few people and form a proper company. Hello, folks. My name is Neil. Welcome to the Fundamental and Technical Analysis series, episode 6, part 1. Today, we are going to look at Bata India as a company to invest in. Bata India was incorporated as Bata Shoe Company Private Limited in 1931 and went to become Bata India Limited in 1973. The Bata Nagar factory was the first Indian shoe manufacturing unit to receive the ISO 9001 certification in 1993. As of 1934, the firm owned 300 stores in North America after World War II. Many of these stores were rebranded with the Barrett Shoes trademark. 1,000 in Asia, more than 4,000 in Europe. In 1938, the group employed just over 65,000 people worldwide. Yes, the beloved Bata shoes that you wore to school every day has its origins in old Czechoslovakia from before the World War I. It went through many ups and downs. During the war, the non-capitalistic countries nationalized that company and took majority stake. The countries that were capitalistic, the company was still owned by the original Bata family. Let's take a look at the financials of the Bata India company, the fundamentals, and see whether it's a good company to invest in. Bata India is primarily engaged in the business of manufacturing and trading of footwear and accessories. We all know that. So let's quickly go and take a look at what Screener has to say about Bata. The company is almost debt-free. The company has been maintaining a healthy dividend payout of 21.12%, and we'll take a look at that. But there are many cons that Screener has to say. Stock is trading trading at 11.92 times its book value, which is expensive, but we'll take a look at that. Company has low interest coverage ratio, but then that doesn't matter because the debt is it's almost debt free. The company has delivered poor sales growth of 2.55% over the past 5 years. Earnings include an other income of 92.17 crore, and company's cost of borrowing seems a little high. Yeah. Now, if you compare it to the peers, Bata India is second as compared to other shoe manufacturing and retailers, Relaxo being the number one as far as market cap is concerned. So market cap, Relaxo has a bigger market cap than Bata. If you look at the profit and loss over the years from 2008, the sales figures have been consistently increasing, except the last couple of years. And I'm going to give them a little bit of a discount because March 2020, we all know, because of the pandemic and such. If you look at the net profit has been also consistently increasing, except March 2020. In March 2020, it remained the same, and we all know why that happened. If you look at the balance sheet, the important things that we look at is assets and liabilities. The liabilities were 316 crores, and then they have increased in a healthy way to 1,377 crores. The assets, though, were double as compared to the liabilities at 658 crores in 2008, but they have increased at a much faster rate than the liabilities to 3,288 crores, so which is many times more than the liabilities now. Yeah. The cash flows have also been healthy, except 2018 and 2020. The cash flows have been not so good. The ratios, return on capital, has been maintained at a healthy 25 to 30% year on year. In 2011, it even went up to 42%, but then it came down and is now at 25%. I don't consider 25% to be a bad return of capital on equity, because 20% is actually considered to be healthy. Anything more than that is good. If you look at the debtor days, it was at 10 days in December 2008, which has, well, gone up a little bit, and then it has come down to 8 days now, which is a very healthy sign. It means the company is able to return their borrowed money within 8 days. Inventory turnover has also remained more or less healthy. I wouldn't say it's gone up or down that much, and it's the pattern that we really need to look at. Now, the shareholding pattern has, the promoters have consistently maintained a 52.96% in the company since June 2018. It hasn't gone up, it hasn't gone down, and that's very good. The promoters essentially have good faith in the company and want to retain their stake. The FIIs were at 6.93, which unfortunately has gone down a little bit. It went down to 4.69 in 2020, but since December, the FIIs are regaining their faith in the company and have increased their stake to 5.33%. The domestic institutional investors were at 24.15 at one point in time, and they have also increased their stake in the company since September 2020. Yeah. The retail investors were at 15.96%, and it went down a little bit in March 2020, which is a very healthy sign, but then it has again gone up a little bit, and then again down. So 15.71%. If you really compare it with June 2018, it is still lower than June. So which means it's a healthy sign, which means the DIIs, FIIs, and the promoters are, well, the promoters are maintaining their stake, but the DIIs and FIIs are increasing their stake by buying off stocks from the retail investors, which essentially means that the FIIs and the DIIs see a growth of their investment in the company if they stay invested. Now let's quickly look at their corporate actions. That tells us a lot about how they share their profits with the retailers. They've maintained a healthy dividend since 2008, year on year. Sometimes they've given it more than once a year. There was a split in 2015. There has only been one split in Bata India Company for since 2008. So after that, it's 2020, so 5 years, 2021, 6 years now. So I don't see any other split in between. It's difficult to say whether we are going to get a split or a bonus in the future, because only one split in the last, I don't know how many years, 12 years or so. So you may or may not get a split or a bonus in the future, but one thing is for sure, they do share their profits with their investors on a regular basis. And it's a healthy sign, which means that they have money to share, they have money to reinvest into the company. All in all, I see Bata India Company to be a good company. And if I were a long-term investor, I would definitely look at Bata India Company as a company to invest in. We are going to cover the technicals of the company and look at the trend analysis and see what would be a good time for a long-term investor, a swing trader, and an intraday trader to get in and out of the company. What would be good entries and exits for all of them? That will be the part 2 of the episode 6 of this fundamental and technical series. I hope to see you then.